All right, let's jump right into the future of Swiss real estate. We're going to break down all the key forces that are set to really shake up the market over the next 3 years. And trust me, these years are going to be anything but business as usual.
So, let's kick things off with the one question that's on every single investor's mind. For what feels like forever, Swiss real estate has been the textbook definition of a safe haven. But things are starting to shift, and pretty dramatically. So, what's really going on under the surface?
The entire market is basically caught in this giant tug-of-war. On one side, you've got these major global headwinds blowing in. Things like new U.S. tariffs that could go as high as 39%, which, of course, hits the export economy and drags down GDP growth. But then on the other side, you've got these unbelievably strong forces at home. A massive housing shortage with vacancy rates at a crazy low 1%, and a central bank that's basically glued interest rates to zero.
So, what happens when you have this big squeeze? Well, it doesn't hit everyone the same way, not even close. What this pressure is really doing is splitting the market right down the middle, and we're starting to see some very clear winners and losers.
And look, we're not talking about little tiny differences here. What we're seeing is a really rapid, really extreme split in performance, and it's happening across pretty much every single part of the market you can think of.
Just look at the commercial sector. This is fascinating. Urban logistics centers, the places that power all our online shopping, are absolutely booming. They're looking at a rental growth of 4% a year. But at the exact same time, older office buildings in less prime spots, they're getting hammered. Rents are expected to fall 2% a year as companies go remote and demand much better spaces. That's a 6-point swing. It's huge.
And guess what? It's the exact same story on the residential side. Single-family homes in those top-tier, economically strong areas are just going to keep climbing. They're pulling way, way ahead of condos in the outskirts, the areas that are getting hit the hardest by the economic slowdown.
So here's the bottom line on this. The very definition of quality has changed. It's not just about a good address anymore. Today, if a building isn't modern, if it's not energy efficient and ESG-compliant, it's in real trouble. It risks becoming what we call a stranded asset, basically a property that just becomes obsolete because it can't keep up with modern standards.
Okay, so while all those market forces are creating one big split, there's another disruption coming, and this one might be even bigger. We're talking about a massive tax reform that is going to completely rewrite the rulebook for owning a home in Switzerland.
First, let's just get on the same page. For decades, Switzerland has had this really unique tax. It's called imputed rental value. It's kind of weird. You literally pay income tax on the rent you could be getting if you rented out your own home to someone else. Well, after years and years of debate, it's officially going away on January 1st, 2028. But, and this is a huge but, it's not just a straightforward tax cut. It's a whole package deal. So while that imputed value tax disappears, so do two of the biggest tax breaks homeowners have always counted on: deducting their mortgage interest payments and deducting the cost of keeping their property maintained. And this just lays it out perfectly. The reform basically creates two very different outcomes. The clear winners are people who own their homes outright, often retirees. They just stop paying a big tax and boom, they have more money in their pocket. The losers? Well, they're the new buyers, the ones with big mortgages. They lose that huge mortgage interest deduction, which means their annual costs are actually going to go up.
And you can already see how this is going to play out. We're fully expecting a massive renovation rush over the next couple of years. Everyone's going to scramble to get those projects done while they can still write off the costs. Then, after 2028, the whole reason to keep a big mortgage just evaporates. So people are going to start paying down their loans a whole lot faster.
Okay, so we've got a divided market on one hand and a massive tax overhaul on the other. How on earth do you navigate all of this? Let's try to boil all this analysis down into a simple, practical playbook for the next 3 years.
For any investor out there, success in this new world really comes down to three things. Number one, go after the stuff that's hardest to find. Target that scarcity. Number two, bet on the clear winner in the commercial space, which is logistics. And number three, look for chances to create your own value. Find those older buildings and upgrade them to meet those tough new ESG standards.
And hey, the numbers really speak for themselves here. Single-family homes are set to be the star players, with prices growing between 3 and 4.5% every single year. And it's not just because they're rare. These new tax laws are going to create this powerful lock-in effect, where current owners have even less reason to sell, making supply even tighter.
Now this is so important for anyone thinking about rental properties.
With rental yields being so low, making a quick buck from monthly cash flow, that's just not the goal anymore. It's all about playing the long game. The whole investment strategy has shifted to what's called total return, which just means your real profit is going to come from the property's value going up over time, not from the rent you collect.
And seriously, remember this. The next 2 years are a really unique window. So let's get practical. If you're a homeowner and you've been thinking about redoing the kitchen, do it before 2028 so you can write it off. If you're a buyer looking at a fixer-upper, you have to bake in the full, non-deductible cost of those future repairs into what you offer. And if you're selling, doing those upgrades now could help you get top dollar before the rules of the game change for good.
So, what's the big takeaway here? The Swiss real estate market is changing. It's not that passive, park your money and forget it safe haven anymore. The days of easy wins are pretty much over. From here on out, it's a strategist's game. Success is going to belong to the people who can see the divides, get ahead of the shifts, and play the long game. The question isn't if you should invest, it's how.